September 2008. A 158-year-old financial institution collapsed overnight. $600 billion vanished, retirement savings were wiped out, and millions lost their livelihoods. But what if I told you the root of this catastrophe began with a simple, seductive question plastered on every billboard? Why rent when you can own? It is 2002. America is still reeling from the dot-com crash, and the 9/11 attacks have sent the economy into a state of shock. To stimulate growth, the Federal Reserve slashed interest rates to near zero. Suddenly, money became cheap, borrowing became effortless, and the national obsession shifted from baseball to buying real estate. Congratulations, you are approved for a $500,000 mortgage, even if you only earn $40,000 a year. It was the era of the subprime mortgage and the infamous ninja loan. No income, no job, no assets. In the early 2000s, home ownership was sold as the ultimate American dream, a symbol of stability and success. Lenders threw money at people as if it were a game show. If you had a pulse, you were approved. Traditional lending standards were discarded, risk assessments were considered too slow, and down payments became optional. Behind this frenzy was a blind faith that housing prices would climb indefinitely. By 2005, a home was no longer just a place to live, it was a lottery ticket. People were flipping properties like pancakes, fueled by the hope that the next buyer would pay double. Wall Street, however, had a darker plan. They bundled these high-risk, toxic loans into mortgage-backed securities and persuaded rating agencies to label them as safe, AAA-rated investments. When these bundles proved too complicated, they created collateralized debt obligations, or CDOs, a form of financial alchemy that turned garbage loans into investment-grade assets. A few skeptics saw the rot beneath the surface. They realized the system was a Jenga tower of debt and leverage. Since there was no standard way to bet against the housing market, they convinced Wall Street to create credit default swaps, essentially insurance contracts that paid out if the mortgage market collapsed. Wall Street, blinded by greed and ego, gladly accepted the premiums, never believing the market could actually fail. Then, in 2007, the tower began to wobble. The subprime loans started to implode. Those AAA ratings turned out to be worthless, and the safe investments were revealed to be radioactive financial waste. Panic spread globally. The collapse of Lehman Brothers sent a shockwave through the world, freezing credit markets and halting the global economy. The government faced a desperate choice: let the system burn or bail out the institutions that ignited the fire. In October 2008, they chose the latter, launching the Troubled Asset Relief Program, a $700 billion lifeline for banks deemed too big to fail. As the government poured capital into failing firms and the Federal Reserve initiated quantitative easing to flood the market with liquidity, the stock market eventually recovered. But for the average person, the damage was permanent. Unemployment surged to 10%, 8 million jobs disappeared, and 4 million homes were lost to foreclosure. While Wall Street executives walked away with record bonuses, Main Street was left to deal with the wreckage. By 2011, the Occupy Wall Street movement emerged, voicing a collective rage against a system where profits were privatized and losses were socialized. No major CEOs faced prison time. Instead, they received golden parachutes. The crisis left a generation with a bitter lesson. When the banks fail, they get rescued. When you fail, you get left behind. The events of 2008 taught us that the next crisis rarely looks like the last. It arrives disguised as profit and stability until it is too late.